Okay, everybody, now we get to the part, this is what we do, this is what we live for. We're portfolio managers, we build portfolios. Now we're at the part we actually can build a portfolio. So we've developed that IPS. We've made those capital market expectations. We figured out the strategic asset allocation. And now we actually get to build the portfolio. This is what we've been waiting for. This is why we're in the industry. Okay, so after developing the IPS, now we've got to construct this portfolio, and we're going to have to figure out how we're going to do it. Now, I love the information that the CFA brings in this section. So there's the traditional approach. This is what you're really hammered in level 1 and level 2. This is pretty much what, I'm a finance professor, and this is our finance department. It's all about mean variance optimization. So you give me an expected return, you give me a standard deviation, you give me a correlation. I can put all these things in a mean variance optimizer, and then it spits out this asset allocation. And everything's great, it's efficient, high risk adjusted returns. It's wonderful. Well, there's one problem with the traditional approach. What do you do when the client calls you to sell all the stocks, or that keeps changing the portfolio because they can't sleep at night? Well, the CFA acknowledges that what's going on in the industry is traditional approach may not work for everybody. So I'm very happy to see the goals-based investing approach being brought into the material. So what does this mean? Well, this means a client is going to have multiple portfolios. Now, are all these portfolios, if you aggregate them together, will they be as efficient as the mean variance optimization approach or the traditional approach? It's highly unlikely. So these portfolios, the biggest disadvantage of goals-based portfolios, they're inefficient. Okay, so that's a huge problem. But there's a huge benefit too. It keeps the client invested. It keeps them with the highest probability of achieving their goals, and they can sleep at night and they're not so worried. So you've got to figure out, as a portfolio manager, can you do a traditional approach? You might not be able to. If you can't, you need to think about this goals-based investing approach. Other thing I want you to think about, private wealth clients, we think about goals-based investing. We typically don't think about this in institutional investing. There is some of this going on, but it's very small. It's mentioned in the literature a little bit, but for goals-based investing, I want you to think about private wealth clients, okay? So these are people. So we're going to dig through, we're going to find out what's important to them. We'll have multiple portfolios, but we're going to optimize each of those individual portfolios. So no, it's probably not, from a traditional approach, an efficient portfolio. It's not the best portfolio we could build, but it's the best we can build given what we're dealing with. Okay, so this traditional approach to portfolio construction. Hey, what do? We're going to identify the asset classes. We're going to develop capital market expectations. What does that mean? We're going to come up with expected returns. We're going to come up with standard deviations. We're going to come up with correlations. We're going to put all those into a mean variance optimization. It's going to spit out this wonderful asset allocation for us. Now, there are all sorts of issues that we'll go into later about mean variance optimization. Sometimes it leads to concentrated portfolios. So we can't put 100% of our portfolio in real estate. So we're going to have some type of constrained mean variance optimization program. And we'll get into that and different models and forms and evolutions. But for now, just think traditional approach is just mean variance optimization. We're going to build the most efficient portfolio, and we're going to hold this thing forever, or at least till the client reaches his goal. So we're going to determine the asset class weights for the portfolio. This is going to be consistent with the client's risk tolerance, and then we're going to have an optimal portfolio. Okay, so this idea, and again, this has come up a little bit. What are some constraints? Well, again, environmental social investing, or ethical investing, this may limit the wealth manager's choice of investments. They may say no oil, no fossil fuels, no companies that don't have women as CEOs or as board members. So there's a lot of ways to slice and dice environmental social governance investing. Just keep your eyes open for it. Again, it is tested in all 3 levels of the CFA exam, and it's becoming more important also in the practitioner world. Okay, and then the last step, you're going to implement this portfolio. So in a nutshell, that's the traditional approach that you've been taught in level 1 and 2. Now we're going to introduce a little bit of a twist. Okay, for the exam, asset allocation approaches, so mean variance optimization and Monte Carlo simulation, we covered them in early sections. So you should be pretty familiar with them, and they're also in level 1 and level 2. So a private wealth manager can use any of these approaches to build, again, this optimal portfolio. So what are we looking for? Risk-adjusted return. We're trying to maximize that. So what are we thinking about? Sharpe ratio. We're thinking about maximizing that Sharpe ratio. That's what an optimal portfolio is. It maximizes the Sharpe ratio, which is the risk-adjusted return. Okay, so we may have to specify asset class constraints in its optimization. Maybe we don't allow short selling. Maybe there's certain assets that we can't use. We can deal with that in mean variance optimization. We also may have to change some asset class weights to incorporate client preferences, again, while remaining acceptable risk limits. Okay, so what are some key points for the exam? So we can use active or passive management for each asset class, or maybe even a combination. We also can think about specific sectors of each classes, and we can use style factors for equity, or even break it out by credit quality for fixed income. So there's a lot of things that we can do, a lot of flexibility. Okay, and when you implement this portfolio, you got to pick the manager. You got to figure out, are you using individual securities? Are you going to use some pooled investment vehicle? And what about hedging? If you're buying international stocks, are you going to hedge that currency? International bonds, or are you just going to let it ride? Okay, and then don't forget about this. Choose the optimal asset allocation. The asset location. So this tax-advantaged account, hey, we don't have to pay taxes on this. Maybe this is where we want to generate that income. Okay, so again, we're going to look at the manager. We're going to figure out, are we going to pick individual securities, or are we going to use some type of pooled investment? We got to figure out, are we going to hedge? And then finally, where are we going to put this account? In which location is the most optimal? Okay, now goals-based investing. Again, this is very different. This most likely will not result in an optimal portfolio, at least according to traditional finance. But I'm going to argue it is an optimal portfolio for the client because it's tailored to them and it's something that they can follow and be comfortable with. So it's really the same steps as the traditional approach to portfolio construction. This is the difference right here. You're going to create multiple portfolios, plural. So each of the client's goals is going to have a separate portfolio. Instead of one portfolio to handle everything, we're going to have separate portfolios for each of the client goals. Okay, moving on. So mean variance optimization, again, we can structure this to give us optimal expected return for a given level of risk. Again, we're still doing that. We're just not doing it a global perspective. We're doing it from each of the individual goals that the client has. So each goal has a separate portfolio rather than one entire portfolio. Okay, and with goal-based investing, this is why I think it's a good thing. clients may find it easier to specify the risk tolerance for each goal rather than the entire portfolio. So funding their retirement is absolutely critical to them, but also almost as critical is funding for their children or their families or their philanthropy. So again, we're still using mean variance optimization, but we have multiple portfolios in goal-based investing, not just one. Now, this is the key disadvantage, and I've already talked about this. It may mean that the entire client's portfolio may not be mean variance efficient. What does that mean? Well, in English, we're basically saying the Sharpe ratio is not maximized. So our return of the portfolio minus the risk-free rate over the standard deviation of the portfolio is not as high as it could be. But again, most likely the clients are going to find this more easier to understand, and they're going to feel more comfortable with it because they can specify for each of the portfolios what is their risk tolerance. So yes, it's important to understand the traditional based investing, but it's also just as important in the material to be comfortable with goals-based investing. And just like anything, I want you to be comfortable with the strengths and the weaknesses. None of these tools are perfect.